We're going to get rolling here today. Just some volatility day to day in the markets. And, we went through the supply demand report last Friday. Not much changing in the grain markets. We just wanted to put a little different focus on this week's webinar. And today, the federal government put out the inflation rate and they pegged it at 1.5%. Okay, and that inflation rate is measured from about June of 20 until early March of 21. And what we find just a bit odd when they say the inflation rate is only 1.5% is we look at a host of what commodities or equity markets or the housing market has gone up over the last 9-10 months. And on the one side of the screen here, we have almost all agricultural commodities. And then the other side, we've got energy and home values in the stock market. Just a few things to point out is on everything that we have on the ag side of it has gone up substantially, except for the milk market. I mean, that's down 10% from where we were at in June of 20. When you look at the hot markets in here, you've got the corn and the soybean and the hog market up 60 to 70%. I mean, those were the strong markets. When you get to the other side, though, and you look at, the really hot markets over there, I mean, you've got steel prices up 145%. You've got energy prices, whether if you're looking at crude oil and net gasoline, up 70 to 80%. Lumber is the one that really sticks out. That's up 125% from a year ago. Then you get down to the bottom, you look at money supply in the stock market up 25%, and home values just keep on grinding higher. Well, we just, and we want to really point this out just from a standpoint that part of the bull scenario in the agricultural markets is inflation, okay, or the discussion of inflation, or can that continue? And it just seems like the Federal Reserve right now is set to keep interest rates low. You have to wonder how high inflation needs to get before they're going to increase interest rates. Our fear with interest rates long term is that they do need to go up. I mean, the Fed rate is at 0, and I just am not one to see negative rates. And if there is inflation, we would get higher interest rates down the road. We just wanted to show you here a few charts. I mean, these are charts going back the last 10 years. You can see where the copper market is hot, getting back near their 2011 high. That's one market when you look at metals or copper prices are up substantially. The market that's probably the hottest out there on the commodity side of it is the lumber market. I mean, you got lumber almost pushing to $1,200 in here right now. I mean, in 2020, at the low, you had it $300 on a board foot. I mean, so from the pandemic low to right now, you've got a 400% rally. I mean, that's just quite impressive. And you have to wonder with this lumber prices if building is going to slow down for what the increased costs are now to build a house. Another market that we think, and this is more ag related, that's really strong. This is the cash hog market. Here we got the cash hog index, the highest since 2014, okay, and that year it peaked out at $1.30. So again, if you want to look at inflation, you can look at a broad swing of commodity markets, whether if you want to look at energies or you want to look at the livestock market, you want to look at grains. The one that we would say has lagged behind, though, is some of the precious metals, as gold has really lagged behind. So if someone wanted to pick, a one out that's a little undervalued, maybe head over to the gold market. Now we're going to get over to the corn side of it quick. I mean, this is, I guess, this week if we walk away with one thing, we're up one day or down the next and have some day-to-day volatility. What I really want to point out here is in 2014, the December corn contract peaked out the second week of April at $5.17 a bushel. Okay, right now we're at $5 to $5.05 on the D's corn contract here the second week of April. And then just going back to 2014 in the spring of the year, all the concern was, boy, if we have some crop issues here, we could get corn to revisit the 2012 high and see $7 or $8 corn. Okay, that was just the general discussion in here as we went into spring planting and looked ahead to uncertainty with summer weather. What ended up happening in 2014 is we ended up raising a good crop. And then we saw these corn futures go south of $3.50 by the fall of the year. So this, when I just go back to 2014, and this red line is where about the high was at that year. Okay, we just have caution, and when we write on a report and even talk in the webinars, we can really argue both ways on this market and try to give both sides. I think from a producer standpoint, you got to look at, hey, how am I going to manage risk? I don't want to miss this opportunity if prices go down, yet I want to have some flexibility if the market's stronger. From an end user, okay, you don't want to get caught if we have a drought, okay, and have to pay up. So there's really balancing act here on both sides. When I get over to the bean market, I've got the red line in here at $12.80 a bushel. We went a little bit above there last week on soybeans, but we put that $12.80 high in because in 2014 the market peaked out at $12.78 that year, and it peaked out in mid-May. It peaked out a little bit later than what the corn market did, okay, but it was about the same level. And there's a similar discussion in the spring of 2014, okay, as with corn. If we have some weather issues, we could see $16 or $17 beans with some major crop problems and visit the drought year high. On the other hand, we ended up raising a decent crop on beans, and then from July forward, this market just rolled lower, and we ended up putting in a harvest low just north of just a little bit above $9. So, again, just like corn, we can really argue both sides of this thing, okay, as we look ahead and what kind of crop we're going to raise and what the weather is going to be. If I'm going to pick out one thing in here this week that's really starting to stick out to us, is where world wheat prices are at. And what I've got listed up here is where the world is offering wheat at their ports. As you can see, U.S. wheat right now is pretty expensive, with soft red winter wheat at $7.55, hard red winter wheat at $7.20. The world's cheapest wheat right now is being offered out of both Russia and Ukraine at $6.72 a bushel. And then some EU wheat, whether it's coming from Germany or Romania, is 10 to 15 cents higher in the $6.80 to $6.85 range. On the very bottom, we'd like to point out that U.S. corn on the world market at the U.S. Gulf is offered at $6.60. So yes, it is a little bit cheaper than what you can get, wheat out of Russia or Ukraine for right now, and even the EU, but they have some freight advantages when you look at sending corn, okay, especially or sending feed grain to the Middle East, or even getting it into Southeast Asia. And so this is a thing we really need to pay attention to here right now on this corn market. And corn producers in Iowa and Indiana or the Midwest need to recognize where world wheat values are at. Now, here's some final thoughts for us today to wrap this up quick. Do we protect some new crop values? D's corn to me at $5. I got to tell you, we're leaning hard to making another sale, or going to strongly consider looking at a D's $4.50 $6 fence. Today, before we walked in here, you could buy the $4.50 put and sell the $6 call, and do that for even money. As a corn producer heading into the fall of the year, knowing you've got a floor at $4.50, a ceiling at $6, that's something we probably could live with. On the bean side of it, just sitting right around $12.60 right now. I thought after that acreage report going back a couple of weeks, I thought we had a legitimate chance on going above $13, okay, or this $12.80, $13 resistance area. That didn't happen. I'm a little surprised that it didn't happen. That tells me, though, that we're probably running out of some steam in here right now. I don't care to put a fence on beans because of volatility. Therefore, you might want to look at 1160 November bean put. You can pick that up for about 25 cents. When you look at wheat, the biggest difference, and we've highlighted this over the previous couple of weeks, is the difference between the three different exchanges. If you want to be bullish on dry weather in Minneapolis wheat, or in the northern plains, look towards Minneapolis wheat. But they have gotten some snow in here recently and called for a little bit of precip. That could limit that a little bit. I don't think it's severe enough to rocket higher. On the other hand, there's enough uncertainty out there to give us some support. I think the biggest thing in wrap up is you need to know your risk tolerance on what you want to accomplish, okay, with the markets, and not only with looking at a futures or options position, but know your own risk tolerance between having enough grain sold ahead or not sold, or having not enough sold, whether the market heads lower or higher. I mean, I just think the worst thing to do this year is to do nothing and then all of a sudden watch this market, break a little bit and had an opportunity to lock up some pretty good values and end up passing on it. I think the volatility is just going to continue. I mean, just look at these last 2 days. and it's only, mid-April right now. If you have questions, we'd be happy to answer them. If not, we look forward to getting out here next Tuesday again. Thank you.